Investors who held Newgen Software over the last few months have watched their portfolios take a brutal beating. The high-flying euphoria surrounding this stock has shattered, leaving behind a trail of rapid wealth destruction. This monthly price chart shows the scale of the damage. A vertical collapse has erased years of gains, with descending red candles taking the price from an 1,800 rupee peak down toward the 400 rupee zone. The market is currently in a state of panic. We are seeing classic falling knife behavior, where the stock drops so rapidly that buyers attempting to find a bottom are simply catching a downward blade. Retail investors remain trapped in a sequence of lower highs with no clear floor. This chart reveals the central mystery. While the stock price crashes, these purple bars tracking quarterly sales are steadily stepping upward. Newgen's internal financial health is actually improving, and its profit margins remain stable. Curious, this creates a massive contradiction. A company successfully making more money than ever before has somehow suffered a 75% total stock collapse. A share of stock represents a future narrative. For Newgen, that narrative has shattered. The market is no longer pricing the business based on its current bank account, but on a future that investors no longer believe in. Newgen's operations remain stable, but the stock is undergoing a severe valuation reset. The hype is simply dying off. During the 2022 to 2024 peak, the market incorrectly treated Newgen as a pure software-as-a-service powerhouse. Investors aggressively priced in a future SaaS stream, paying massive premiums for growth that had yet to materialize. This tracks the price-to-earnings ratio. During euphoria, these blue bars reached extremes of 80 to 90. Now we see a sharp drop. The stock finally slammed back down to this dotted line, the historical median of 23, flushing out the bulk of overvaluation risk. We see the exact same pattern in the EV to EBITDA multiple. It rocketed past 50, but has since crashed back into the 12 to 15 range. Institutional investors are now completely refusing to pay premium multiples for this business. These red candles track the inevitable gravity of historical fair value, pulling an inflated bubble back toward the median. Newgen is currently in a Wyckoff Stage 4 downtrend. This is a pure markdown phase, defined by large institutional players systematically offloading their shares to retail buyers. The technical structure confirms this. The price action is trapped in an uninterrupted sequence of lower highs and lower lows. On the daily chart, there is no plateau or sideways base, just a downward staircase. These volume spikes at the bottom tell the real story. The highest trading activity occurs exactly when the price is crashing. Compare those to the tiny anemic bars whenever the price moves sideways. This disparity signals intense selling conviction and zero buying interest. This environment produces dead cat bounces, brief upward movements on low volume. These spikes routinely trap retail investors who jump in thinking they have found the bottom, only for the downtrend to resume. Until this institutional distribution phase exhausts itself, any isolated green candle is a trap. The selling pressure remains firmly in control. There is a critical difference between a cheap stock and a falling stock. A cheap stock is a value opportunity. A falling stock is a source of capital destruction. Professional entry requires specific conditions. First, the price must flatten into a sideways consolidation for 2 to 3 months, shrinking volume towards zero. Next, we look for structural confirmation, a higher low followed by a strong upward breakout on heavy volume. Looking back at the historical base formed in 2021, a strong demand zone exists between 300 and 320 rupees. This is the level where buying pressure previously overwhelmed sellers, making it the most likely candidate for a new floor. Because the trend is still down, the current allocation should be limited to 0 to 3%. Scaling to a 5 or 8% position is only appropriate after the base is confirmed and the downward momentum has stopped. Successful investors do not guess the exact bottom. They let the market catch the falling knife first, buying only after the floor has been proven solid. This chart shows Newgen's valuation reality check. Notice the dramatic plunge in the market cap to sales multiple from its peak. Investors paid 17 times sales. Today, it rests right on the historical median line of 3.9. The pure SaaS narrative is dead. This shift creates a new investment thesis. Moving forward, Newgen's performance will rely strictly on business execution and earnings growth, not on market hype or multiple expansion. Our final verdict places Newgen strictly on an accumulation watch list. Aggressive entry is off the table until the current technical destruction phase ends. Significant market returns occur at the transition point, when a broken, overhyped narrative settles into an undervalued execution story.